Good morning, everyone. We're going to give you a brief but important presentation on why we use layers in PTF Pro version 1.3.7. And we're going to do that through presenting a comparative results analysis on a pair, PDS versus SPN, and take you through the upgraded functionality on layers in Pro and why you want to use them in your pair trading. Again, the disclaimer notice, I won't harp on this, but it's your money, your risk. Never trade anything that you can't afford to lose. And we do not give individual financial advice or any financial advice. Information and educational purposes only. So what's it all about? Well, first off, you may not know what layers are, but as part of the functionality upgrades in PairTrade Finder Pro, we have implemented consolidated layers profit and loss reporting in the backtests, in the trade history, and in my watch list. So what is a layer in PairTrade Finder parlance? Well, and why do we use them? If you look at when you create groups, there is a box that says entry stretch layers, and these allow you to scale into a trade. The top 30 equities pairs signals, as they autoload to your PairTrade Finder Pro, generate entries at a entry stretch of 2.0 standard deviations of the ratio versus its 100-day moving average. Okay, and if you don't understand what that means, then you're going to have to go through our materials and just understand basic pair trading stuff. But let's assume that you get that. Now, what are layers? Well, this is saying, well, instead of just putting on 10,000 a leg at an entry stretch of 2.0 and then waiting or hoping it comes back to 0.0 for your exit, why don't we put on part of the trade at 2.0, part of the trade at 2.5, part of the trade at 3.0 entry stretches. So if the spread blows out or the ratio is way out of whack, we're not going all in at 2.0 and then getting a big loss. We'd be going in part at 2.0, part at 2.5, part at 3. And so that's what you use this box for that you see in the orange circle, to put in different entry stretch layers. And let's be clear about something. You have above that a trade value per size. Don't look at the long value and short value boxes. These are hardwired not to be working right now, and I apologize that that's not that clear, but it's the way the Pro is coded. The trade value per side that you see above the $10,000 or 5 or 1 or whatever you put in is what will be the leg size of each entry layer that you set. Okay, so hopefully you get that. Let's move on and take an example. So before we do, let me just quickly run through the pros and cons. That's always a good thing to do, because every technique you have for mitigating risk or improving risk reward in your trading has its pros and cons, and layers are no different. So what are the pros of scaling in a manner like this? Well, it may provide a superior average entry price. So instead of getting in at the ratio at 2.0, maybe you get in at 2.5, maybe you get in at 2.5 and 3. Your average will be 2.75. So if it's a spread or a ratio that diverges a lot, you may get a better entry price than the 2.0 because it may go a lot further out. So in that sense, you're mitigating your risk of a spread blowing out after entry. And importantly, it's a stepped and volatility-based entry rule. So as the spread is diverging, volatility is increasing. Therefore, to hit a higher standard deviation level, it has to move even more. So it's a way of timing your entries to the volatility of the pair and stepping them in. And that can, again, lead to a superior average entry price and mitigate the risk of a spread that's moved very far, very fast. Now, what does that mean, though? So why do we do that? Wider entries mean fewer trades and possibly higher win rates, lower drawdowns, and lower commissions and margin over time because you're using fewer trades. So we'll look at that in a second, and I'll go in more detail on that. Now, when you combine it with a less ambitious exit, let's say plus or minus 1 standard deviation instead of 0.0, the strategy means that full mean reversion doesn't need to occur to have a profitable trade. So, if you've gotten in on an average price, let's say you did a layer at 2.5 and a layer at 3, those are much wider entries than 2.0, and you might say, well, why don't I exit at 1.0? and I'd still get almost the same juice out of the trade. And so in that sense, if you were to set your exit at 1.0, you provide some protection against trending ratios, which if you've been pair trading, you realize is not what you want. So like everything, it's got its negatives. So what happens if you set it too high? If you set your entries at 3 and 3.5 standard deviations, well, if you know bell curve, 3 standard deviations is about, I think only about 2% of the time or 3% of the time the ratio will be at that level, and 3.5 it's even much less than that. So you may miss a lot of opportunities like the ones that happen at 2.0 standard deviations. Okay, so that's something you have to watch for. Next, if your first layer is set at 2.0, because you want to make sure you get in a trade, and 2.0 is a reasonable place of entry, it may not go past that. It may only go to 2.2, 2.3, and that means you're half-sized or 1/3 position sized in the trade, because you have to watch your position size. You don't layer in full position size at each layer, because you'll be way over risk weighted in that trade. So you go at, instead of 10,000 a leg, you're going in at 5,000 per leg twice, or at 3,300 a leg 3 times. And if it doesn't diverge wider, you've got more missed opportunity. Third, if you lack discipline, you might chase it and you might throw on more layers, and that does lead to oversized positions, and that's probably the worst possible situation, because you've got a spread that's blowing out. You feel like you want to get in more because it's way, way, way wide. Well, there might be some reason in the market that you don't know why it's blowing out so much. The news may not capture it. And if you chase it, you start getting more into the position than you wanted. You can lead to an expensive blow up. So avoid that mistake at all costs. And then finally, I think the biggest con, and something you need to mitigate, and that's why it's great to have a fabulous software that allows you to do this easily. Fewer trades per pair per year, which you'll see in a second, means you need a much larger universe of watchlist pairs to keep your capital fully employed. And does that lead to lower quality pairs being selected? So I leave that for your consideration. So here's a quick example. So in Pro version 1.3.7, so here's PDS spin, and we're going back into trade history over on the left here, and you'll see in July 2017, we set the parameters for this at 2 layers, an entry at 2.5 standard deviations and an entry at 3, and we set the exit stretch at 1.0, and we put $5,000 a leg per layer entry. Okay. Now you'll see on the left-hand side in the trade history window, it entered on the 11th of July because the spread blew out, or sorry, the ratio went wide, and the deviation was closed at 3.08 negative. Okay, so that triggered the first leg of 2.5. That triggered, it's above 2.5, therefore the first layer was put on. Now the next day it came back in below 3, it was at 2.78, then it was the next day at 2.89, then it went wide again, and this time it went to 3.98. Okay, wow, so a lot wider, and that triggered the second entry because it was above 3.0. So what happened? Because you set your entries at that level, you got, instead of getting a 2.0 trigger and you're in the ratio at 2.0, and then all of a sudden it goes way back to negative 3.98, which means you'd be in a big loss on your position. Instead, you got in at an average standard deviation of about 3.5, which puts you in a nicer position for a reversion and makes you think, hey, I don't have to chase this all the way back to 0 in order to get a profitable trade. So what happened next? Well, it's a good trade. It came right back in very quickly. And you can see the exit in the second orange oval in the middle there, and that happened at -1 standard deviations. And in fact, if you look at the blue line in the trade window, is at -0.86. Okay, and you can see in the trade history window over there on the left, the P&L column on the right-hand side of that window, and that is the daily layer consolidated P&L going back historically. So both of those layers are included in the P&L that you see there. And yeah, so that's how it works. So you've got a double entry and a single exit. Important to keep in mind, if you're going to scale into a trade, never scale out. If you've ever run the mathematics on that, they just don't work. So if you're scaling in, you exit in one go. Okay. Over on the right-hand side, you see the ratio. And as you can see, it came out, we entered twice, then it came back in. We exited when it was at 1 standard deviation. And here I wanted to highlight that exit at 1 standard deviation. Look how it just touched the ratio line. It did make it to 0.0. Okay, so if you had been trading 2 and 0, this would have been a profitable trade and you would have had a clean exit. However, what if it hadn't just touched that? What if it just came to like negative 0.1 and then turned around again? Well, you'd be all the way in a loss. Whereas on this trade, exiting at 1.0, you're out, you've got a clean trade, and you've got very good economics on that trade because you had an entry at 3.5 and exited at 1. Okay, let's take that into a back test and see what that means over time. So here's what we're going to do. Over on the right-hand side, here's your create group, and we're going to set it up for PDS spin. We're going to go on a 3-year back test, and we're going to go $10,000 a leg with an entry at 2.0 and an exit at 0.0, 60 days max days in trade, commission where we usually set it, and it's just one layer at 2.0. So that's exactly how the top 30 are set up. Then over on the right, we're going to go $5,000 a leg with 2 layers of entry, one at 2.5 and one at 3.0 standard deviations with an exit at 1.0 standard deviations. These can be plus and minus, okay? All of these ones in the titles there. But right now, just for simplicity, we say it's plus. Now you'll see on the right, we set the trade value per side. Look at the orange arrow in the middle there to 5,000. That dictates the value of each layer. Okay, you can only set one value for each layer, so you can't have different values for each layer. We're going to do that in the next upgrade to Pro, but for now you have to go in at 5,000 or 3,000, whatever you set in trade value per side, that's what you go in at for each layer. The exit stretch over there on the right orange arrow is set at 1.0, and then the entry stretch layers, as you see on the left of the right box, is 2.5 and 3.0. So pretty exciting. Let's see what the different results are when you run these back tests. So on the first one, $10,000 a leg, 2.0 and 0. You've got 11 trades over those 3 years. You had a compound annual growth rate of about 19%, max drawdown of 20, profit factor of 5, 72.7% winning trades, average net profit a trade of $614, a total net profit of $6,756, and your commissions that you paid your broker were about 14.1% of your gross profit. And your average days in trade were about 32. Your biggest win was almost 2,000. Your biggest loss was 800. What happens when you do it the way we're talking about with layers? Well, instead of getting 11 trades, you got 5. Okay, and we call, even though you go in, scale into a trade once or twice or 3 times, you only exit once, so we call that one trade. Okay, so you had 5 trades, some of which were scaled in, some of which weren't. Okay, you had a compound annual growth rate of 23, so 4% higher. Your max drawdown was lower, but most importantly, and you'll see this in the equity curve, you had a 100% win rate. So you didn't have a single losing trade. And most importantly, your average net profit per trade was higher, 852 versus 614. And very importantly, your commissions and slippage was only 9.6% of your gross profit versus 14.1. However, your total net profit was lower than with the $10,000 a leg, and that's because you had fewer trades. However, they were more profitable trades and they were all winners. So that leads to a very different equity curve, and if you combine this over a portfolio of 50 or 100 pairs, it leads to a very different portfolio performance overall. So that's really what this is all about and why you use layers. You're getting increased reward to risk, and you're getting reduced number of trades, more profit per trade, lower commissions and slippage, and hopefully a higher win rate. So that's why we use layers. And let's just take a quick look here at the equity curves. So on the top one, it's $10,000 a leg. You can see in the first year of that back test in the orange oval, the pair barely went anywhere in the first year. Then look down below at the layered entry. In that first year, you had a very good trade and made a lot of money. Okay, so that's a big difference. Then if you look at the blue ovals in the last year, so in the last 12 months, let's say, this pair has been up and down in the $10,000 a leg, and in the $5,000 a leg, it's still up. Okay, and then if you look over on the right-hand side, you'll see the ratio is blown out. Okay, at the very end, look all the way over on the right. This would be a horrible trade to have gotten in because, wow, our ratio is blown out. But what's happened? in the last year, if you are using layers, you're still in profit. Whereas if you're on the $10,000 a leg, 2 and 0.0 entry and exit, you're now losing money on that pair for the year. So that's a pretty good illustration of why we want to use layers as a risk mitigation and reward increasing technique. And then just finally here, this makes it more graphical. The plus minus and the ratio charts. Look at the top one, 10,000 a leg. You can see all the entries and exits over the last 2 years, and you can see them mapped on the ratio. And compare that to the one below, where you see there were 3 closed trades and 1 entry, whereas up above there are 1, 2, 3, 4, 5, 6 closed trades and 1 entry. So half the amount of trades, therefore half the amount of commissions and slippage, more or less. And if you look over on the ratio line in the bottom chart, you can see you're just kind of surfing the extremes and getting out while the getting's good, let's say. Whereas on the one above, you know, it's like you're in the middle of the battle. You're going in and you got to get across the line, going in, got to get across the line. The other one is more like you're sniping from a distance. And that's a good way of thinking about this. So when you're using the layers and you exit at 1.0, it's more like being a sniper. Whereas when you're doing 2.0 and exiting at 0.0, it's more like being a swordsman in the heat of the battle. So that's a quick look at layers, why we use them, and how they can improve and affect your trading. We are doing all of this educational material in conjunction with our January sales special offer on Pro version 1.3.7, which has those great consolidated P&L numbers and lets you track layers and backtests. What's that offer? $385 a year for PairTrade Finder Pro. That's 40% off our retail price. You're saving over $275 a year. We have the special bonus. We've updated our top 30 US equity pairs. Those are free. That's a $249 value. We have a free 3-hour pair trading video training course, which we think is invaluable. You got to know what you're doing before you put any real money at work. And we have, of course, our Trade Like a Hedge Fund ebook. You get that for free. That's got 11 trading tips from pro pair traders. Knowledge is power. Here's what you do. Just click subscribe now link below this presentation. Don't wait. There's only 5 days left on this offer. We think it's a great one. We'd love to have you on board, and happy trading, everyone.